All right, Sarah, thank you for doing this. I realize that you've been spending more time being the interviewer than being interviewed, but I appreciate you doing this, and it's nice to be doing it in your office.
Yeah, well, any excuse to hang out with you.
The first thing I want to ask you about is what a VC firm sort of is. And the thing I've been thinking about a bunch is when I was doing Lattice, I kind of knew what a company was. Like, you build a product, you sell the product, like there's like a sort of a very tractable thing. And then over the last year doing venture full-time for the first time, it struck me that it's a much more sort of flimsy concept. And, there's obviously like a fund that owns shares, but then there's like a brand and there's people and there's these other parts. And as I've been thinking about building a VC firm, I've realized that thinking about what it actually is sort of like a wispy idea. And so I would love just to hear from you as you've thought about, you've been at one, like a very substantial, longstanding one. Now you've built your own. How do you think about what a VC firm is?
We've taken like 2 steps toward building our own.
You've done something though.
It's an interesting question. Like the way we think of it internally is, and it's not like the most flattering view, but venture is a bundle of like money. I'm thinking about the value prop to the customer, right? The customer is the founder. Venture is a bundle of money where like everybody's money is approximately green, right? You can have like lower and higher quality LPs, but generally that's not how founders make their decision. Then you have people and beliefs that you are associated with as a founder. And then you have advantage, right? Like what and I wouldn't do the job if I didn't figure like that the last piece could matter at all, but help you can give companies and to try to make things happen faster or make ideas like more possible to actually make real. And it is a weird way to think about venture as a business because for all tech investors love to talk about like moats and differentiation and sustainable advantage. I think venture, like when you think about those components, money is the purest commodity. The rest of it is pretty squishy. It's a lot of like brand and individuals that feel quite fragile or like point in time. But some of the great venture brands, they've been around for a long time, and I think it's still possible to build an enduring institution. So
yeah, and some of those brands something is compounding there. And I guess maybe that's an interesting sort of way to pull on the thread is like, what is compounding at Sequoia or Greylock or these firms that have been successful for decades? What's the thing that is like hard to knock off balance? Like what is the thing that's making is it the brand? Is it the network of founders? Is it something about the way they do business? Like what is holding on through different years and teams and cycles?
Yeah, well, I would start by saying like I actually like really want to try to live like this, and I think your entire like personality expresses this, but like this doesn't feel like a particularly zero-sum environment. I think you can try to build a new thing without saying we're like completely after somebody else. But in terms of durability, I think you have like ethos, right? Like what matters to the people in a firm that goes from generation to generation and different investors. You have like some tribal knowledge, and that is like what has worked in the last generation of companies, good and bad biases, like the history of technology, right? Like here's how Apple or Google or NVIDIA did it, or Facebook for that matter. And then you have brand, which is just obviously what founders think of the place, how much success you've had, and then you have network. And I think those are the things that are harder to replicate very quickly. I think you also, if you are at a platform venture firm, you have a lot of capital available to you, but there's also just a lot of capital in the world.
Yeah, I want to come back to what you said about sort of the zero-sum nature of it all and to what degree, more value gets created versus, venture capitalists are capturing. I've heard some people say that they think that great founders select, like the truly great founders are actually selecting for a different thing than other founders when they're thinking about their VCs. I can't remember, but who all, but one name that comes to mind, I know Parker at Rippling has said that like brand is the most valuable thing that he can get from a VC because it makes it easier to recruit, easier to get the next customer, et cetera. And like he's going to do the work anyway. And so at least he can get a brand. Do you think like, as you've experienced sort of working with companies and founders, do you think that there are different attributes in a venture firm that different founders prioritize? And does that impact at all the way that you want to build when you think about, your founder is the customer, but obviously you're looking for certain founders within that customer set?
Yeah, I definitely think we don't have to appeal to everybody. I think if you are going to go to the sort of highest prestige brand, like you want to buy, I don't know. I was going to say like IBM, but I mean this in a flattering way. Like you want to buy like the known winner.
Apple, let's say.
Apple, you buy Sequoia, right? And like, number of challengers in the established tier. But I think a lot of people make like founders are not a homogenous set. And like, let's just use examples here. I think a lot of people make decisions very individually. Right. If they know, and we also want to back first-time founders who've never met anybody in venture capital, and we talk about how you build that trust in those relationships. But Brett Taylor, when he builds his third company, he's just calling people he wants to work with. He does not care where they work. Right. I don't think he like particularly cares about the brand of the firms. He is working with firms with nice brands, but he is picking individuals, probably because he doesn't feel like he particularly needs the halo. I think if you asked Parker, because I have, like, I'm pretty sure he called Mike, actually, because there's, and maybe that's also a symptom of him also being a third-time founder. I think his specific words here were like, if I were ever to build another company, please God, no. But I'd call Mike. And so I think that at some point, like, the things that you feel like you want help with or support on or how much brand matters to you change as a founder.
For sure.
And so we want to attract a particular set. And I think our brand does stand for something. We're trying to make it stand for something now, but it doesn't have to be like the most established prestige. We actually can't go back in time and do that.
Totally. Yeah. Okay. I want to shift to brand now because this is it's something that you've done notably. I promised you I wouldn't like ask like a question that was like rooted in flattery, but like you've done a good job branding the firm since you started. And actually, in some ways, I would say the last sort of really great firm to be built that I can think of, that also launched with what I think was a very strong market presence was Andreessen. This is like 2009. And like all of a sudden they were like everywhere. They did many things. They like dominated PR. They were like, investing in great companies at what seemed like then high prices. Many of them, were actually still really good investments from there. But like there were a bunch of things that let them get this brand very quickly. And then they scaled rapidly and all of that. And in some ways, there was not, another firm that did that. And, at risk of flattery, you've built a very good brand very quickly, and you've kind of been everywhere. And, people see you in a lot of different places, in high value places. They see you on good cap tables. They see you at good events. They see you, they see you just like frequently. To what degree is that just what's been happening by a product of you sort of working hard, having a clear view and whatever? Or to what extent is this all like wrapped around like an intentional goal, building the firm in a particular direction, and this is part of the story?
There's a founder that we both know who has like a medium scale SaaS business now. And at one point I lost an investment at my prior firm to Andreessen. It was a Series A for this company. This lovely founder was like, hey, love you guys, but they're paying more. And like, let me, like, I was like, oh, well, like, it doesn't matter. Like, all of these other things matter. And we sat down in a bar for like 3 hours, and he explained to me like how he saw the firms. And he basically was like, these things, like, they look pretty similar, except they look bigger and like they're better at PR and they're willing to pay more. And I was like, that's a bummer. I took this like list that this founder gave me and like stuck it on my office door at my old firm for a number of years. I was salty about it, or wanted to like try to solve the problem. And so one of the things that I think you just like think about when you start a company and you've worked on early stage companies for a while is like who said this originally? Like it's such an important thing. Like nobody cares. Nobody cares about Jack or Sarah or their firms or your new startup. And so like you have to make them care. The other thing that like we thought about was just if we think we are good partners to entrepreneurs, like why should they know? We have to like solve an information asymmetry for them. And one of the things that this founder said to me is like, you say you have a good network. They say they have a good network. It all kind of looks the same. And so one of the things that we wanted to do, and like all this stuff is like, I don't know, you can just like try stuff and then see what sticks. But one of the things that we thought would be important would just be like demonstrate who the network is to founders in ways that are like accessible to them without us like man-to-man combat, women-to-women combat, proving it. And so we did a bunch of what you would consider to be, if you were in a company, as like a SaaS founder of Lattice, be like partner marketing.
Yep.
Right?
That's a good way to look at it.
And we're like, if it was a business, it would be a funnel as part of marketing. Like, what can we do that is efficient with people who have the distribution that we want, that like us? Like, okay, let's go show up with NVIDIA and Snowflake and OpenAI and whoever it is that is part of the community we want to be part of.
I mean, there's also the reality that you doing, to the Parker point, there's reality that you doing the brand work actually also helps the companies in some ways because, you doing branding can help at least at the early stage companies, there's value to it. So you talked about, there's like partner marketing, which is sort of like express the network. Yeah. You also touched on something before, which was like stand for something and then like, share that. Is that like an essential part of it? Is that like the center of it is like believing something in the world and like that's what the marketing is about? Like, I know like this was like a Steve Jobs thing was like, we stand for something at Apple and like that's what Apple's brand is we believe in like, we believe in, XYZ things. And I think like that could be the analogy here. But do you think of it, is it network? Is it stand for something? Is there a third pillar? Like what are those components in your mind?
Be willing to take risk on having an opinion is an important one for us. I think a number of founders choose to work with us because they believe that like the firm is AI native in terms of understanding of these sets of things that the companies are trying to do. And then some is access to network, some is understanding of the research itself, some is just like company specific challenges. I also think that maybe entrepreneurs, like if you like want to go one level deeper, like I don't know what the world looks like 20 years from now. I really hope that like Conviction as an institution exists. But if you think about the like name we chose as well, it is like have an opinion. Maybe we're in the like post-AI abundance age and like venture is irrelevant or like we're on to the next big technology thing. And I hope the people at the firm, and maybe it's me, like are on to the next big thing too. But part of the core ethos for me about venture is like I want to understand the new thing and then like we take risk on it. Like we published our LP letters recently. Some of those beliefs and predictions are going to be wrong and look very stupid. But for a generation of entrepreneurs right now where everybody is in like a very dynamic environment and I think people are unwilling to like make any claim about understanding or about prediction. I think that can be like very grounding of like, well, at least these people have an opinion and I can decide if I have that worldview or not.
It's actually funny that you said that because about Conviction, before you said that I had been thinking of the brand as AI native. And now that you say it, I actually can immediately re-understand it as have strong conviction. And what we believe right now is that AI is the most important thing. But if in 10 years that's solved and now it's about space travel, like Conviction could be about space travel. And that resonates. That makes sense to me. Do you think that in venture, do you think like brands typically like need to follow returns, or do you think like do returns follow brand to some extent? Is there a strong correlation or causation between these two things?
I think the most important part of brand should be success. And success for a venture firm is like the quality of the companies. I actually don't even think that most founders have that much visibility into like how early you are or like how much of the companies you own. And like, sometimes I think like that would be useful to founders to have more transparency around where like, hey, that person that like says they're part of this journey bought secondary at the Series F, right? And that's like probably different than working on the company for 8 or 10 years. But I think like year zero, you got to do something.
It also brings up a funny point, though, of like from a founder's perspective, what is a VC being successful? What does that mean in the way they care about? Like, should they care more that you partnered with important companies or that you deployed a lot of capital? Or should they care more that you got crazy returns in companies they never heard of and didn't play a role? So it's not so obvious. And I do think that there are firms that can kind of impact the direction of capital flows and firms that are working with the most important companies that maybe don't have as good of returns as firms that are, not doing those things. And so I do also, as we're talking about it, wonder from a founder's perspective, which type of success is actually important. Like I joked recently that somebody was talking about like, oh, why should a founder want to work with that company? They're huge and they don't have big returns. And I was like, if I'm, thinking from a founder lens, I'm like, low returns for them means that was less dilution for me. So that sounds great. It's not so one-to-one.
Yeah, I think it's a really good point of like, I actually don't know that founders should care about the quality of our multiple. I think that is a proxy for like something founders should care about, which is taste. I do think some of the very best people, if you ask them, like when they say they're choosing brand, they care about association with quality and with success.
Yeah.
And so if you do a small number of companies and the hit rate is high quality and the people is like a set of people that you would be excited to learn from, I think that is attractive, right? And there is often a debate about whether or not you learn more from success or failure. I believe you learn more from success.
Me too.
And so I think people want the tribal knowledge, going back to like what is a venture firm really, of like what is working at like the handful of companies that are really working in this era. And so I think we want that to be part of the value prop and then part of the brand. But to your point of like, should founders choose the same thing? And are the incentives fully aligned? I think not. Like there's a whole range, right? And I think it is. I actually joke with my partner Mike of like, I think it is very reasonable if you think about if a bunch of VCs can argue about whether or not they're good operators, but once they've been investors, like how might they raise money? They might raise money from their friends. They might raise money from the like highest taste people and people who are most helpful. They might also raise the most money they can at the least dilution possible with the least control. It really depends on what you're looking for and like what your view is of what you're looking for from your investors. And so I also think it's like very stage specific. I don't think that founders should be optimizing for our returns. I think that's just a proxy for other things they might care about.
As you think about the current market landscape, and you'd been investing, professionally through the teens, and then you got to, live through sort of the ZERP escalation and like sort of late stage SaaS before AI and all this other stuff. For me on the founder side, what I remember in 2020 and 2021 was all these crossover firms that I just thought were hedge funds like came and were, doing all these crazy market distortions. And as founders, everyone was like, cool. But like that was what was going on. Then everybody kind of went away in 2020, 2023. And now back in 2025, we have what looks to me like a similar but different dynamic where the crossovers don't seem to be back in a particularly important way, at least. But you have the sort of bulge bracket institutional VCs that have gotten as big as those firms were. And they're now, 3 or 5 or 9 billion or whatever. So you've got that going on. The other thing that I think is interesting that you sort of were maybe the first of the most recent set, but there's like a number of now successful GPs that have left multi-stages, started their own firms. So now there's going to be, there's always new firms being started, but there's now a set that is sort of like ostensibly going to be slightly more institutional over time, probably smaller. But so you have these two sort of ends of the market going on at once. And you have, AI mania, which, as we know from, internet in 1999 could be undervalued still, could be overvalued. Who knows? What do you make of the shape of this market right now? What does it mean for where you think people can successfully play? What do you think it means for you and where you want to be playing? But like, what's your read on that sort of market map?
Starting a venture firm has like made me slightly more cynical about the industry. I'm the opposite of a cynic in many ways. Like I'm a deep optimist about technology. I like working with really earnest people. I try to be an earnest person. But it is clear to me that raising money, like the capital markets are really deep, and raising money is an awful lot easier than making money in venture from a returns perspective. I think like if you actually think about the economics of a venture firm to the investors, there's a crossover point of like you could be a best in class in any vintage investor delivering, let's say like respectable 8 to 10 times multiple returns on a small fund and make not that much more money than somebody who's charging traditional venture fees on a fund 10 plus times your size, right? And so I think there's a very rational thing happening in the maturation of certain asset platforms where it is very easy to unconsciously be attracted by growth because like, you've built a company, growth feels good. Growth is not a natural state for venture. It changes your ability to invest, right? But people are growing their firms. It's also like a natural organizational thing, right? If you hire young people and then you hire 10, then you hire 50, like they got to go
grow
somewhere.
Yep.
And that also means that means opportunity, that means comp, that means agency. So I think that like a very natural thing has been happening where these things that were little boutiques are acting like businesses. The businesses businesses naturally grow. There's capital available to them. The feedback loop for whether or not the returns are supported are also distorted by the fact that lots of people see the backwards-looking multiple of the best funds of the vintage right before ZERP, and were under-invested in venture and are still trying to invest in venture. And the outcome of all that to me is there's obviously secular increasing opportunity in technology over time. And that's the thing we index as venture investors. And so I think there should be some growth in the venture industry. I think this is askew from that, and it will not end well in terms of returns for folks. But it is also just maturation of the asset class. And so I don't know that it goes away. If you take private equity as an asset class prior, or those platform businesses, it is very hard to make money in private equity at a top tier, and people are not moving money out of the asset class.
Does it skew the ability for small firms to make money because these big firms, though, are going to play at every stage? And in the same way that the crossovers got into late stage growth and were starting to do non-economic things, do the venture firms that are huge, or is it rational for them to do non-economic things at seed because it fills a pipeline and they know that they're just going to play a different game on the winners and take a different IRR on that? And does that impact the whole ecosystem in a big way?
I think it does. And so I think if you ask me what could I be wrong about in the whole strategy or the ecosystem, I think there is a point of view of you can't make money in venture anymore in terms of an outsized multiple in early, because it's just a sourcing funnel for the late stage firms, and the expectation on multiple, the cost of that capital is lower, right? And so and you can just spend resource on it subsidized by the growth firm to, be more competitive at early, right? In terms of marketing or people or whatever. We have 8 people today. We had 6 people until last week. I guess I would posit until proven wrong. I think in the very early end of the ecosystem, we're not trying to win everyone. We only have $200 million of capital. We need to have a couple really important companies to have a hugely winning fund in every cycle. You don't need that many people and that much money to compete, because people are looking for different things. And the experience of working with you or working with a very specific set of people that have an opinion and have some certain understanding is quite different than working with a very large business. And people choose different things. It's not a homogenous market.
We talked about how there's a certain type of round that is obvious. Sometimes obvious is Brett Taylor at the seed, but maybe more often it is Cursor or something like that, a company that is really working, and there's things in the middle, there's things past that. But as you think about, these types of companies ranging from completely not obvious to extremely obvious, and you think about where money is most likely to be made and line that up against the dynamic we've talked about with, Sequoia is able to play a dominant strategy of they can go win the obvious things at a very high rate. Small firms can do different things. Where do you think that leaves, if you had to, take your best guess of where in today's market, the most alpha exists? Is the winning strategy right now to become able to win things? Because to this recent point, there's the non-obvious feeders, but there's more money to be made at doing the first obvious round. Is it the much later stage stuff where actually the $10 billion companies look much better than the $1 billion companies because, we now live in this world where things are going to get way bigger than we thought? What is your current read on where the pockets of value are at the moment?
I think it's a super interesting question, but I don't spend that much energy on this question in particular because my orientation is actually just my taste is my taste, and I'm an early stage person. I actually think my taste is pretty mainstream in many ways, right? Let me contrast this. I think we will have opinions on companies that other people will not have, and we might choose to be earlier or make it's very hard for me actually to tell what the mainstream opinion is, right? Because if you remember the GPT wrapper era, where nobody's going to make any money in the application layer, and now it's you're only going to make money in the application
It was
layer.
crazy how that flipped very quickly.
Yes, exactly. And so one thing is like, I don't think a lot about, I think great investors do this, but not me. I don't think a lot about like, where is the risk reward and like, a lot does. Like, where's the risk reward in like the mid stage, the late stage, the early stage? Because I'm like, well, I'm only good
Doesn't matter.
at that.
I've got my game. It doesn't matter what.
I am pretty sure being great at early is going to be valuable no matter what. And I'm not like globally optimizing. Right. And then I think your point of view on product and people just is what it is. I do think that if you think that let's say you just want to be able to win whatever opportunities you want to work on, then you have to like build your ability to win. Right. So brand does matter to us. I think there are like seemingly very effective alternative strategies. Right? You can own a particular community. He'll hate that I even mentioned his name out loud, but I think Zach Frankel is very good at this, right? He works with a really small number of people. He has good taste. He does well. If you look at what Matrix has done, the quality of some of Ilya's companies, I think what he would say is like, hey, we're not here to compete in the like general brand game and put a lot of energy toward that. Yeah. It's not really me, but
he's in incredible companies.
But he's in incredible companies, and
he
like,
did them when times when they weren't obvious.
Absolutely, there is definitely alpha in choosing to be controversial on purpose. And like, I look at some of his investments and I'm like, Flock Safety, like good on Garrett, that's amazing. But like, that didn't make any sense to me when I met it. Shame on me, right? I was just like, this is such a weird company. Like, cool guy, weird company. I think like your taste is what your taste is. Yeah. And we are probably more willing to take technical bets and then like go further down the thread of like, hey, we have a thesis around this particular area, or we'll take a bigger slug at something. Then I think one of the benefits of being an early firm versus a multi-stage firm is a specific framework for one of the best growth firms out there is we want to invest in the most important companies of tomorrow as early as it's clear that they're the emerging market leader. But that means you could do it like as soon as the company's in traction or like right before the IPO, right? And because we do not have this luxury of like waiting until the market has panned out and all the cogen companies have like fought it out and one is waiting at the end and then like maybe you're paying a $20 billion entry price for it. We're just going to choose, right? Like whenever we think that company like enterprise value can be built, we'll just take the competitive landscape as it is.
On this point about, you're now running your own thing, you can sort of You have the luxury of now investing the way you want to invest.
Figuring it out
as you go. But you have, you get to adapt as you see what you like and what you think. I want to sort of reflect on your learnings because we're investing very differently at Greylock, but they're objectively very successful. Mm-hmm. And you worked closely with Ashim, who, as is like really different style of investing where, I saw that, people talking about this recently that he's like never lost money. And this is like also not, somebody who's just making safe investments. He did great stuff with that, but it's a certain type of investing. To me, in some ways, what you're doing now is, maybe opposite is too dramatic, but it's like quite different where, if that was very linear, very clear, he could probably name, several companies that ought to exist that don't yet and how they might be built. You're operating in sort of like the most shifting of, sort of sands underneath, the space. And so I'm curious what what your reflections are going from that experience to now investing this way. And maybe more interestingly, is there anything that, despite how different they are, is there anything from that you take to this that somebody who hadn't had that Greylock experience wouldn't have?
So much. I mean, like I learned to be an investor at Greylock. It is one of the great firms. I think Ashim is one of the greats. And I think having his hit rate on both all three of capital preservation, doubles, and home runs is like, that's fucking amazing, right? What to learn. So I think that there are patterns of investing that are like we were talking before and you're like, oh, it's nonlinear. I appreciate like linear thinking is clear thinking, right? You can follow somebody's pattern of logic. And one thing that is like characteristic of traditional firms that I think is a very valuable thing is your understanding of how an existing market works. I think a pattern that's worked really well for some investors that spend more time on traditional markets is they know the talent base in that market. You could take security or storage as an example. Mike Spicer is also amazing at this, right? And then or Anil Bhusri when he was a full-time investor, right? And it would be like objectively true that for any point in time, like the dominant markets are incumbent existing markets, right? And you just look at what the transitions are that are macro technology, and then you make the bets on the right types of people given that transition in an existing market. 3 check boxes, right? I don't know, like you have amazing intuition for investing, but like maybe you didn't practice this specific thing, seeing the pattern of it. And like, let's take an example. If you look at the biggest categories of security spend, you might say, category 1 of security spend, given the shift to the cloud, how does that change? Category 1 of storage, given the shift to flash and the quality of consumer flash and the ability to manage that with software, how does that change? And then who are the right people? A lot of those people work at the incumbents. I'm not saying that's like all of traditional venture investing, but I think there are patterns that are really powerful where the existing network and the understanding of how those businesses work, like I'm really glad I got to learn a little bit of it. And try to replicate some of it. I do not think that what I'm doing now is the opposite of that. But again, like venture is like such a, companies are an expression of the like personalities and taste of founders to a great deal, right? And I think venture investing is also a very personal thing. Even when you're responding to customer needs, it's still like, Lattice, it was a lot about you. I'm curious about like the things that change most, right? And one of the things that made me believe that there was actually an opportunity for a new firm was that the like AI technology shift would actually mean that the most interesting markets were not necessarily the markets that already existed. Right? Like, let's say enterprise infrastructure and like systems of record in the high end. I love businesses that look like that, by the way. But some of the categories of company that we are lucky to be a part of, like they attack markets that are not traditionally software markets. Harvey in law, Sierra in like actual support work. HeyGen is doing the work that, SMB video agencies did before, or just creating new capability. And so I think if you were very traditionally market focused, you might not have the time to see them in the same way.
Are you trying to bring some of the like equivalent market linearity to being like, you're spending all this time understanding AI right now, and you obviously, have spent a lot of time just knowing regular business markets. Are you trying to intersect those and think like, I'm still going to be founder driven, but this year I want to find a company doing, something in XYZ vertical because like my triangulation is that this should be happening soon. Do you do it that way, or are you like following founders and networks?
We do both. There are a lot of people out there with really good ideas. And I think it's like better use of your energy as a venture capitalist in general to listen to founders' ideas, right? And just like be educated by them and be able to make the right decision when you see it. That being said, like you spend a lot of time talking to customers out in the world, like let's say you've ever been an idea person. We made one investment in the portfolio we haven't announced yet where I like carry around my little like set of PowerPoint slides trying to convince founders to start this company for 5 years.
No luck.
Well, we finally found the company.
Oh, you got it.
Yeah. Well, I mean, we didn't convince them to start the company. They'd already started the company. But I was just like so thrilled to meet them because I was like, no, stop your presentation. Let me show you like we believe, right? And so I think there were like one of my partners now, Pranav and Mike are working on like a space where they want something to exist. And so I think we'll actively go hunt for people that we think would be great to start the company. Just be like, you should start this company.
The couple times that I've done that and put like a little beacon out in the world, I have found that like it does help attract the people who are it somehow makes the people who are working on that more likely to come find you, and you're a much more prepared mind when you do it. So I do always think I should be spending more time doing this than I have been.
Yeah.
I kind of want to shift into like AI and not necessarily like prognosticating about the future, but like you do spend your time here.
Yeah.
And so like I want to try a little bit, or at least to sort of like hear your thoughts on some recent commentary. There was like a good quip recently that I was like, that's a good reframe from Satya talking about like, this AGI stuff is great and we should think of it that way, but like I'm looking for like 7 to 10% growth. And I think it was like a soundbite that sort of it did something where I think it sort of changed the conversation from like inputs to outputs, basically. I think it in many ways gets at the overall question of just like, is this market big enough for, you know, the tens of billions or hundreds of billions that's going in from the hyperscalers and the 100 billion that's going to go in from VC and all this other stuff. When you think about where we are and how you'll see the signs that like the outputs are following the inputs, are you thinking of this in a, I just want to see, you know, more companies that are at a, you know, 50 or 100 million that are durable? Are you thinking about something on the intelligence layer? Like, what is your frame of mind when you see like that kind of thing from Satya?
I think it's a super like rationalist decision from Satya. I think it is a statement that he does not believe that owning a particular lab or research effort that gets to a reinforcing fast takeoff is going to lead to a lot of economic value capture, or that the probability of that is not worth spending many billions of dollars, right? But I think the view of like, hey, we're just not seeing enough revenue adoption to make $50 billion of capital outlay into model training every year worth it for us is completely reasonable, right? He's responsible to public shareholders. I have a much easier problem, which is I am quite sure that there's going to be enough economic value created to return a best-in-class venture multiple on $200 million. The way like we try to stay rational about it, but like I think if you wanted to back up the truck and just like only do capex heavy foundation model companies, you just raise a lot more money than we had.
Yeah.
Right.
Yeah.
The signals we look for are like actually going back to like what do you take from traditional venture? I'm like, I really like to see revenue. One of my companies talks about EBITDA. Do you remember EBITDA? It's a very, very exciting concept. There are companies that are creating user value very rapidly, and they're not spending a lot of money to do it. I think you can be more or less expensive as a business to grow. Like we'll do both. But it's really nice to see that some companies are being capital efficient about it.
One of the things that I think is interesting is that we're back in sort of like 2021 in a way where like 100 times ARR rounds are like not particularly uncommon on things that, you know, are growing fast and, you know, have a reasonable base and whatever. I remember in 2021, sort of the kind of the general wisdom was, hey, we all thought there were going to be X number of $10 billion companies, but there's actually going to be like 10X and there's going to be a lot more $50 billion companies than we thought and so on. And, you know, we all just had like the wrong idea of the size. And it now looks like that was like mostly wrong. And I think in some ways now we're back to thinking that in a way that, you know, at the moment, at least, you know, feels more right. You know, that could change in the future. But like, are we still investing, even at the early stages, in ways that require there to be a lot more $10 billion companies than there like ever have been? And like, are we collectively betting on that?
Absolutely. And I think it will be true. Like, let's talk about the mechanism of action when like people thought this in the SaaS world, right? I think some of it ended up being, and like speak up because you actually did this, but you know, as an analyst, right? Some of it ended up being true. More people than ever before, like in businesses, got to consume software for their business because it became cheaper to use, because you didn't have to like buy packaged software and operate it, because it filled many more functional gaps, right? And because you had internet distribution, right? You got cheaper to actually sell to people. That's how I like think about like, oh, why should we have more SaaS? The thing that I think the market got wrong, or one of the things that the market got wrong, was there was not infinite ability to like cross-sell more software into the organization in any segment of business, right? SMBs, mid-market, enterprise businesses.
Enough became enough at some point.
Enough became enough. And like they didn't want to buy any more darn SaaS. And there was just a limit to budget and a limit to consumption. And like that seems rational, right? Like in contrast, well, that seems rational in retrospect.
Yep.
I'm sure we're wrong about something else with AI now. In contrast, I have poo-pooed on generally working in healthcare tech for a long time, not because of lack of interest, but I'm just like, okay, I was one of like 3 people at Greylock that 10 years ago got staffed to like go look at digital health. And we looked and it was like not it was not a good look, right? You want to sell to providers. It was slow. There wasn't much budget. It just didn't change the business that much. I now sit on the board of a health healthcare provider tech company, and it's growing really fast. And there are other companies that are growing really fast. I think that people just didn't build stuff that was worth buying enough for a long time. And it's sort of mimetic now to say like AI eats services. But I think if you just like think about the value provided, it is not necessarily like service industries. It's just technology does way more. Yep. And your willingness to pay as a consumer or as a business for these things that you like, again, like could have been part of your job being done for you, could be a legal service, could be like be skilled to be creative, could be education. Like those were different budgets.
Yep. What's interesting on that point that makes sense to me now why it's happening, but I'm not sure how it plays out over time, is at the moment, agents, for lack of different term, are replacing labor instead of software. And so the price that they're comping to is labor. Mm-hmm. And so instead of SaaS being, $100 a year, $200 a year for a person's seat, an agent can be like, oh, it's $40K a year, which is way cheaper than your software engineers or way cheaper than your accountants. You're going to save $70K a year by just giving us 40 per agent seat. And so there's this very strong pricing potential that you can have.
Yeah.
And that seems, at least at the moment, like it could be rooted in sort of the existing paradigm, but in the future, does that pricing stay, as competition goes? And so that's one thing that and I say this as somebody who's like investing in companies building agents, but I'm like wondering how that ought to play out, because it's like, will this eventually price relative to like cost and like an appropriate margin, or like it used to be done by people, so we're just going to kind of peg to that forever?
I think generally there will be like absolutely very strong pricing pressure. And I really think about like what is the basis of competition some number of years from now. If you have a unique offering where the customer really wants what you are offering, and I think like people don't really know what like the moats with agents will be, but like let's assume there is uniqueness in some set of offerings. Like if you're Figma, pricing pressure is different than if you are one of many different companies. Like people just want specifically Figma. There's nothing quite like it, right? And your team is in it and you're going to use it. So I think there's some set of companies that will end up with that dynamic, and they will be able to retain some sort of value-based pricing. And then I think like the majority of companies will probably gravitate toward like, cost of compute or energy or intelligence plus.
Yep. Yep.
But like I have no idea how long that takes. Right now, like I basically think a lot of it ends up getting pushed to consumer and business surplus, as it should. Right now, it's just like, wow, the surplus is so good, even if it's, a third the cost of an engineer.
It's sort of interesting because it felt to me like for a while, before AI, it felt like in order to come up with a good idea, you had to be like kind of non-consensus. At the moment, it feels like there's actually a lot of ideas that are both like consensus and right. And then the reality is then you get like, a lot of competition and it floods and they kind of all do really well. So I'm curious to see how it like plays out. But there's a few of these spaces like support and CodeGen and these things where it's like everybody knows it's working. They are indeed all working, and that's just not even close to the market demand yet. The last topic I was curious to get your thoughts on are there was a good post about like agency being more important than intelligence now, and intelligence is like abundant, and so like the thing that's left is agency, which I want to believe this, that like that's the model of the world, and that like they'll never come for our agency, and we'll see if that's true or not. But I'm curious, as you've talked, you spend a lot more time than you probably ever have with AI researchers, and you think about this. So I guess, do you see it that way? Do you agree that like agency is going to be the sort of like last human resource? And then like, do you think, if so, does that like impact the way that you think at all about like the types of founders you're investing in?
I'd focus on being hot and funny.
That's good. That's high agency.
No, I don't know if I have like a good answer to this question. I guess I never particularly thought like intelligence was enough anyway, right? And so like when like it sure helps, right? When you think about the founders that we select, like without being over a particular bar, like all other things considered, like of course we're going to back people who are really, really smart. I was on this campaign at my prior firm to try to be more specific about how we talked about people. Because it's like very easy to say like, oh, the person is special. What does that mean? The thing that we most look for is, besides intelligence, is kind of like force of will and the ability to like take a point of view and be right. Right. And so I don't know what that is. Maybe AI is going to have better predictive power than founders about the future of different markets at some point. Like the ability to generally navigate the world and shape it to what you want. Like, I don't know if that's how you think of agency, but like that doesn't feel in grasp of pure intelligence anytime soon.
You have 3 kids like me. Are you thinking about their education at all, or what you think they need to learn, or what you're teaching them, in this, as you're thinking about what's obviously happening now?
Of course I am. I don't know if I'm like doing anything about it. Our kids are young enough that like I think about like behaviors as much as like knowledge for now, right? Like frustration management, the ability to concentrate, right? The ability to upskill yourself in something. I think those are going to be important no matter what. For now, like maybe if you just assume that like information retrieval will get better. Andrei Karpathy like is very convinced that you still want to build like certain types of reasoning pathways in kids' brains before they get too much older. And the like purest forms of reasoning are essentially like STEM reasoning, which is funny because we seem to be making like very good progress on coding and STEM reasoning in these models today. But I still think like the ability to like structure a logical problem, decompose it, and debug it, like that seems useful, and your ability to use even all of these tools will be better off for your ability to do structured reasoning. And that seems like, there's a reason, mathematicians don't tend to prove a lot like after the age of 25 or some really sad number. Like those pathways get built. I guess I like subscribe to that pretty mainstream view. But I also think like I am willing to be like very flexible about what education looks like for them 10 years from now. Like if it's not Stanford, it might not be, traditional education, right?
All right. Well, Sarah, thanks for doing this. I really appreciate it.
It was so fun to hang out.